On January 29th, 2026, silver hit an all-time high. The rally had been extraordinary. Prices had surged more than 130% over the course of 2025, powered by record industrial demand and a structural supply deficit. A global wave of investor enthusiasm pushed the white metal to levels no one had ever seen before. Then it collapsed. Within days of that all-time high, silver had shed nearly 50% of its value in a violent precious metal sell. By mid-March, silver was still sitting approximately 33% below that January peak. Battered and volatile, retail investors are now asking the most expensive question in commodity markets: is this the dip to buy? The answer, based on current market structure and institutional voices, is not yet. And this video will tell you exactly why. We will examine the specific signals you need to watch in the next 48 hours and the days beyond. This is not a bear case on silver's long-term future. The structural story for silver is intact. Supply deficits and demand from solar AI infrastructure and EVs remain. But a bull market is not the same as a safe entry point. Welcome back to the channel. Today we are doing a careful, evidence-based analysis of the silver market. We need to separate three things: the long-term fundamentals, the medium-term macro picture, and short-term timing risk. Confusing them is how retail investors end up holding painful losses while waiting for a recovery that takes longer than expected. We will look at what JP Morgan, Peel Hunt, and other institutional voices are actually saying right now. Before we begin, nothing in this video is financial advice. This is educational market analysis. Every investment carries risk. Silver is one of the most volatile assets. Always do your own research and consult a qualified financial advisor. To understand where silver is now, you need to understand what actually happened in January 2026. Silver's 2025 rally was driven by a confluence of forces, including a sixth consecutive year of structural market deficit. The gold to silver ratio had reached 105x in early 2025. Historically, the ratio has averaged around 60x. Betting on silver catching up to gold became one of the most crowded positions in the commodities complex. That crowding made the collapse violent. When momentum stalled, the unwinding of positions happened with extraordinary speed. Leveraged positions in futures markets began to unwind. Retail investors who piled in near the top faced margin calls. U.S. Treasury Secretary Scott Bessent described the late January rally as a speculative blow-off. The result was a sell-off that erased nearly 50% of silver's value, a move of stunning violence. The dip looks attractive. Silver is now trading at levels that were considered expensive just 18 months ago. Historically, sharp pullbacks in strong bull markets have often been excellent entry points for patient investors. The problem is the current journey. Several near-term headwinds make buying this dip right now a significantly higher risk proposition. The first and most important headwind is the macro environment created by the Iran conflict and its effects on the dollar. Headwind number one, the dollar and the rate equation. Silver is priced in US dollars. When the dollar strengthens, silver becomes more expensive than every other currency, which suppresses demand from international buyers, particularly the large Asian markets that have been a crucial driver of physical silver demand. And right now, the dollar is in a period of unusual strength driven by a specific and powerful mechanism. The Iran conflict that began on February 20th, 2026 has sent oil prices sharply higher. Oil is traded globally in US dollars. When oil prices rise, global demand for dollars to pay for energy increases, which supports the dollar's value. At the same time, higher oil prices reignite inflation fears, and inflation fears push back the timeline for Federal Reserve interest rate cuts, which further supports the dollar by making dollar-denominated assets more attractive to global capital. The data reflects this clearly. The Federal Reserve was previously expected to cut interest rates at least twice in 2026. Markets are now pricing in at most one cut, and the CME FedWatch tool shows that rate traders do not see a cut until December. A strong dollar combined with delayed rate cuts is a classically challenging environment for non-yielding precious metals like silver. This is a structural shift that directly undermines the key monetary argument for buying silver. Money sitting in silver earns nothing. While money sitting in dollar-denominated assets earning elevated interest rates generates real returns, this matters to institutional investors. Headwind number 2, industrial demand is not a guaranteed cushion. The bull case rests heavily on solar panels and electric vehicles. Industrial demand is real. The Silver Institute projects a 6th consecutive year of structural market deficit. Fabrication demand is at record levels. But if the Iran conflict pushes major economies toward recession, industrial production contracts and silver demand contracts with it. The solar sector is actively working to reduce its silver intensity per panel. This creates a natural ceiling on demand at higher price levels. JP Morgan's analysts noted they are much more apprehensive about silver than gold because silver does not have central banks as structural buyers. Headwind number 3. The technical picture is not resolved. The silver chart right now is in what traders call a distribution phase. Silver peaked on January 29th. It then suffered a crash that erased nearly half its value. Since then, it has been consolidating. The weekly relative strength index had exceeded 18-year peak, a level considered a serious overbought warning signal. Professionals were targeting the $70 to $75 range as a genuine support base before looking to The specific 48-hour warning in this video is a reference to the cluster of macro catalysts landing in the very near term. U.S. jobs and inflation reports are landing in this window. These reports matter enormously because of the rate cut timing question. If the data comes in softer, the rate cut timeline could shift forward, which would be a meaningful positive catalyst for silver. Any meaningful de-escalation signal in the Iran conflict would reduce oil price pressure and ease dollar strength. Before these catalysts land, buy-in silver is accepting a risk. Waiting for them to resolve is the disciplined approach. The long-term case is still intact, but that is not the point. To be completely clear, the structural bull case for silver over a multi-year horizon remains one of the most compelling in the commodity complex. The accumulated supply deficit between 2021 and 2025 is estimated at approximately 900 million ounces. China has implemented new licensing restrictions on silver exports effective January 2026, reducing the pool of eligible exporters significantly. Russia announced a plan to spend $535 million acquiring precious metals, with silver as a primary target. Pelahunt raised its long-run silver price estimate to $50 per ounce, acknowledging the structural undersupply. The gold-to-silver ratio has compressed from 105x at its peak to below 55x currently. The industrial demand story, particularly silver's irreplaceable role in photovoltaic solar panels and infrastructure, remains a powerful long-run structural driver. None of this is in dispute. The long-term bull market for silver is not over. The structural deficit is real, but a dip in a long-term bull market is not automatically the right time to buy. The right time to buy is when the macro backdrop shifts, when the technical base is confirmed. Right now, the silver market in April 2026 is sitting at one of its most consequential inflection points in years. The short-term picture is dangerous. A dollar strengthened by oil price pressure and delayed Federal Reserve rate cuts argue for patience. JP Morgan said it plainly. They are not comfortable re-engaging with silver until the froth has been fully shaken out. Watch the jobs numbers, watch the inflation data, and watch the dollar, because that variable is determining silver's near-term direction. Silver will have its next great entry point, but the best entries come to those who wait for confirmation. The silver trap is buying this dip before the picture clears and watching your position go lower just as the real opportunity emerges below. Be patient, do your research, and stay disciplined. If this breakdown gave you a clearer picture, hit that subscribe button right now. Turn on notifications and leave a comment below.